Hi, Marty James here. I want to talk to you a little bit about charitable contributions and how they actually relate to your IRAs, especially for those people that hit 70 and a half. So back in the day, which wasn't too long ago, this was when required minimum distributions started at age 70 and a half. They also put in this thing called a qualified charitable distribution. And it really makes sense to do this with your IRA money, and I'll explain that a little bit more here. But when the Secure Act passed, they took the required minimum distribution age from 70 and a half up to age 72. But they did not change the eligibility to do qualified charitable distributions. Those stayed at 70 and a half. Now, you cannot make these deductions before, so say I'm 70 and a quarter, I can't do it. But just as soon as I hit 70 and a half, I can. So that year that I turned 70 and a half, I may want to delay my charitable contributions until I do hit 70 and a half. So essentially what happens is, you instruct your custodian to send the money for your charitable contributions directly to the charities. Now, they can do this in a couple different ways. One, they can send it directly to the charity, or they can send the check to you made out to the charity so you can put it in the plate, on Sunday morning. But essentially what's happening is you take this money. So I put my money into my IRA. You don't want to do this with a Roth, by the way. You only want to do this with a pre-tax type retirement account. So I put this money in this retirement account, and I tax deducted it. So now when I take it out, I'm going to pay taxes on it. And so it shows up on the front page of my tax return. And then, of course, when I turn now 72, the IRS is going to tell me that I have to start taking money out. Well, if I can direct this money directly to the charity, missing out on taxes, on this, because what happens is it's not included in my income. Now, I don't get it deducted on my charitable contributions on Schedule A for itemized deductions, but with standard deductions for a lot of clients right now, they're just taking the standard deduction because of the limitations on how much we can deduct for state and local income taxes being capped at $10,000. So it really takes your either mortgage interest and combination of charitable contributions to get you over that. So it's very effective to do this. So, and one of the neat things with this is, if let's say I'm required to take $10,000 out of my IRA because I'm now 72, and if I take that $10,000 and have it directed out of my IRA, now I'm getting my full deduction for my standard deduction, and I didn't have to spend any money to do that. I'm actually not having to include money from my IRA distribution in my taxable income, because this QCD actually qualifies to help me meet my required minimum distribution for the year. Now, the thing that you just really need to be doing this, and I'll show you an example of what the actual tax savings are, for this when I get back to my office. But even for younger people who are not 70 and a half, you need to be talking to your parents about it, because, hey, I'd rather inherit the good stuff, the cash, the things that's already been taxed, rather than their stinking IRA that's got all these taxes that I'm going to have to pay. So you really need to be talking to your parents and your grandparents about this thing, because if they're not doing it, it helps them, and it's definitely going to help you. With that, hey, just, when you get a chance, before you get off this, be sure you subscribe to this channel, because we have a lot of ideas we're pumping out that you may not be getting somewhere else. Okay, let's look at why we want to be doing this qualified charitable distribution from our IRA when we're 70 and a half. One thing I didn't mention was that how much can you do, and each person can do $100,000 out of their individual IRA per year. So I have a married couple, that could be $200,000, but it has to come out of each one of your IRA. If one spouse has all the money in the IRA, I'm stuck with the $100,000. So we have actually done this in situations where we've taken much larger amounts out than what your normal annual charitable contributions are. Example was, we had a client that had a will that said that, hey, I want $75,000 to go to the church when I pass away. And so in the will was, or in her estate, basically, is all this good stuff that is going to step up in basis, and the kids are not going to pay any taxes, when she passes away. However, we had this IRA out here that when she passes away, the kids are going to pay taxes on that when they start taking money out. So since charities don't pay taxes on it, what we did is we took that provision out of the will. Churches no longer get $75,000, But what she did is she did a $75,000 QCD, qualified charitable distribution of $75,000 directly to the church, and now the kids are going to inherit less money that's tax invested in that IRA and get to inherit all the good stuff without having to give that to the church, who doesn't pay taxes anyway. And the other outcome to that was that, we had the charity got the money earlier, and then now her required minimum distributions are going to be lower, which is going to control her tax bracket a little bit more going forward. So here we have a situation where I have a married couple. They are 72, so they're taking required minimum distributions now, and that amount I've got that pegged in at $25,000. But they also make $15,000 annually in charitable contributions. So under alternative one, you can see here, this is where they're taking their required minimum distributions out of $25,000, and then they're writing checks to the church, $15,000 a year directly out of their bank account. In alternative two here, we have where they're directing $15,000 out of the IRA to go directly to the charity, and of course that can happen in two ways. We can send it directly to the charity, or we can make a check out to the charity, send it to you, and you can put it in the plate on Sunday if you want to. The other $10,000 is actually coming out as required minimum distribution, is going to land on the front page of the return, and that's the difference in the total income here. Sort of, there's more moving there, because you can see that's more than a $15,000 difference. Now, in both scenarios, we're taking the standard deduction, which they increased a few years ago substantially, got rid of our personal exemptions. So it's $27,800 here, by taking my RMDs, and it's $27,800 here by doing the qualified charitable deduction. So buried in this alternative one scenario, in that $27,008, I would be trying to deduct my $15,000 charitable contribution. But because I don't have enough state and local income taxes, my medical expenses, thank goodness, are not that high, I don't get over that $27,800, so I just take it. Here, I've just taken the $27,800. I don't have, my charitable contribution is not in there, and I'm actually effectively getting kind of like a double deduction here. So what happens is, when we look at our actual tax difference here, you can see that under the scenario one, where I take the $25,000, put it on the front page of my return, and then write the checks to the church, it's $15,812. Here, where I take it directly out of my IRA, it's $10,116. So it's a substantial savings. As a matter of fact, it's 38% of that $15,000 contribution, which is pretty good. So how do we get there? Let's look at their income. So we have $1,500 in interest, which is taxed at regular ordinary income tax rates. I have qualified dividends of $2,000, which are actually taxed at capital gains rates, which would be like 15%. And I have capital gains distributions from mutual funds of $8,000. Here's my IRA distributions. There's $25,000, but then here's only $10,000 because I put $15,000 directly to the charity. I have $37,000 in pensions, and my Social Security benefits. I still get the same gross amount, but you can see there's a different amount being included in my income. I'll show you how we get to that. So that's where my total income starting point is there, and my adjusted gross income, I have no adjustments, is 125 and 103. So when we look at the retirement income, you can see there's my $25,000 IRA distribution for my RMDs. Then here's my $10,000 RMD, and that $15,000 again went directly to the charity. So what does that do? My Social Security benefits are $61,694 as a gross amount. So it's the same in both scenarios. But because of the calculation of what we call provisional income, how much of our Social Security benefits are taxable, we can pay taxes on up to 85% of it. Sometimes it's like 50%, and sometimes if my income's low enough, it's zero. So in this calculation, I actually take where my taxable Social Security benefits, by putting that $25,000 on the front page of my return, raises that provisional income calculation. So now $52,000 goes into the tax calculation for my tax return in that scenario. Here, by getting that 15,000 off, by going directly to charity, my provisional income's lower, so I'm only including 44,000 in. Now let's look at the actual kind of analysis of this. So you see here under scenario 1, I'm in a marginal rate of 22%. Scenario 2, where I did the QCD, I'm in a 12% bracket. Okay, so that means that next dollar that I earn is taxed at 12%, but because of the taxation of Social Security here, it's a little better than that. So if we see how we blend through the tax brackets here, I have 10% rate and then 12%, and then I have $7,090 being taxed at 22%. Here, where I did the QCD, I have nothing in the 22% bracket. All my ordinary income is being taxed at that 12% bracket. But then when I drop down here, you can see by putting that RMD directly, on my tax return, that extra $25,000 worth of income, I'm paying $10,000 on my qualified, or I'm including capital gains taxes on that $10,000, which is $2,000 from my qualified dividends and that $8,000 in capital gains distributions. So my capital gains taxes is $1,500. Here, because I'm now into that 12% bracket and I got it low enough that that $10,000 it's tax free for federal purposes. I'm not paying any income taxes on it. So when we look at how that works, I mean, basically we have a tax savings of $5,696 just by shifting. All I'm doing is just moving how the money's moving out of my IRA. This is something that everybody who's 70 and a half that makes charitable contributions really needs to be thinking about and needs to be doing, because even at income levels lower, it can work. And the amount of money that you actually save depends on all these other moving parts. We'd love to run these numbers for you and show you what it would look like, but it's something that just don't miss this. We're still seeing people miss this, and a lot of times financial advisors don't bring this up to their clients because honestly, I think some of them are thinking, okay, if they're doing 15,000 and I'm being paid, let's say on a fee basis type thing, assets under management, I'm sure that they might be thinking, that hey, I'm getting paid on this $15,000 still in here, and if I send them out, I'm not going to get paid anymore. Let them spend the other money. And so a lot of advisors just don't bring this up. Of course, a lot of advisors don't look at your tax return for ideas. So like I said, everybody needs to be looking at this when you turn 70 and a half. Now, you cannot do this until you're 70 and a half. But, just so you might want to delay those, the year that you turn 70 and a half, delay your charitable contributions and then start, and make that up. But yeah, again, just consider this and reach out to us. Drop us an email, give us a call, and we'd be happy to show you how this actually works.